You already know this video is brought to you by the amazing programs on building your wealth and that Black Friday coupon code expiring at 11:59 p.m. on Friday. Check it out, link down below. Hey everyone, me Kevin here. We've got some risks to talk about for the market, and a lot has to do with the Federal Reserve. Now, we've already had conversations about what happens if we just get Brainard. Is she just going to be a mirror image of Jerome Powell, and is it going to make a difference? Or if we keep Jerome Powell, is the market just going to shrug off the fact that the chair ever even came up for renomination, and who cares? We've also talked about timing. We've talked about the fact that Joe Biden told us that we should have an answer within the next 4 days on Monday, which means we should have an answer today on who the next chairperson for the Federal Reserve is going to be. Is it going to continue to be Jerome Powell? Is it going to be Brainard? Is it going to be somebody else? But now we're hearing that the decision might come over the weekend. And at the same time as hearing that the decision might come over the weekend, some folks think, maybe we'll hear when we finally get to Thanksgiving and we'll hear by then. Who knows? The point, though, of this video is to highlight two potential concerns and potential issues related to this nomination. Because while we wait for Joe Biden to get his nomination up, we can finally look at something like the Wall Street Journal's editorial board and say, wait a minute, these are two real risks that maybe we haven't considered before. So take a look at these risks. First, as a preface, before we talk about the two risks, it's worth noting that the Wall Street Journal's editorial board agrees that Brainard will probably be very much like a conjoined twin to Powell and act very much the same as Powell. That is, keep rates low, keep essentially the taper moving at a relatively slow pace, and be patient with the market. Wait to see what happens with inflation before acting too fast or potentially too quickly to tighten. But the Wall Street Journal editorial board gives us two potential risks. The first of the two is right here. Take a look at this. The Wall Street Journal editorial board basically goes as far as calling Brainard a flip-flopper. Look at this. Donald Luskin of Trend Macro notes, Brainard struck a dovish tone in September of 2016 before the election, but on the eve of the Trump presidency's inauguration in January of 2017, she suddenly discovered that the Fed was close to its inflation and unemployment targets, and 2 months later called for tighter monetary policy. So here, the Wall Street Journal editorial board is giving us a warning. You're giving us a heads up that, hey, wait a second. If we get Powell, we might have somebody who stays consistent, who stays the course and stays with that inflation's transitory argument through the middle of next year. If we get Brainard, while we think that she's going to be on the same course, that might be the oversimplification. She could end up flip-flopping just like she has in 2016 and 17, where she previously flip-flopped literally on the same discussion, inflation versus tighter monetary policy. This is a warning. This is a risk to the markets that, hey, if we get Brainard, we have a higher likelihood of a sudden flip-flop than we would with Powell. But the second concern that the Wall Street Journal editorial board brings up really comes after they just utterly crush Jerome Powell. Listen to this. Neither one deserves the job, Powell or Brainard, if you judge them based on how well they have performed in their main duty of maintaining price stability. The Powell Fed has presided over inflation that it failed to predict and has been slow to address. The Fed's professed inflation target is 2%, but the consumer price index rose 6.2% in October, above a year earlier. By any measure, this is an historic failure. Mr. Powell's credibility has been damaged with his persistent refrain, until recently, that inflation is transitory. His new monetary policy framework of average inflation targeting, this is, by the way, formerly known as FATE, Flexible Average Inflation Targeting, unveiled in August 2020, has been a bust. Now, obviously the Fed would say, hey, well, wait a minute, we designed FATE for a 3 or 4 year time frame. It's going to take time to see flexible average inflation targeting. You can't just average over a few months, you got to have average over a few years. So obviously Powell and Brainard would probably defend the Fed dramatically here. But it's interesting where the Wall Street Journal editorial board takes this next. If Biden wants to distract himself from the inflation failure, he'd nominate a current critic of the Fed policy. This is interesting. So take a look at this. They're playing politics. The Wall Street Journal editorial board is basically saying, if Biden wants to first of all probably get his Build Back Better plan passed by somebody like Joe Manchin in the Senate, which now we've passed the Build Back Better plan in the House, but it's going to be up to the Senate to pass it, which is really going to hinge on 2 votes, Kyrsten Sinema and Joe Manchin. And they're very worried about inflation. So here, if Biden wants to distance himself from this inflation failure, he'd nominate a critic of current Fed policy to basically show he's very different and doesn't agree with what's happening with inflation. That could actually be what's needed to get Joe Biden's plan through. But that could create some shakeups in the market, right? Take a look at the recommendation they make. They suggest, and they even admit they never thought they'd say this because the Wall Street Journal leans conservative. They suggest here that Larry Summers, a Democrat, would be a logical choice given his basically his persistence on inflation coming in higher than expected. That is, Larry Summers is somebody who at the beginning of the year said that Joe Biden's $1,400 stimulus check plan would lead to rampant inflation, that the White House is underestimating inflation, that inflation is going to come in way higher, and what we need are stronger actions by the Fed. In fact, the Hill reported the following quote, from Larry Summers, "My experience is that you should hope for the best and plan for something less than the best. I think that means stronger action by the Fed. It means the administration has to be thinking about inflation." And this is essentially a response to the Fed being weak on inflation, being potentially behind the curve, being wrong about, here Larry Summers said, they said when September came and people went back to school that the labor force would grow, and it didn't. Inflation doesn't look like it's transitory, and they said that inflation would be behind a few specific factors, but it doesn't seem to be specific factors, it seems to be everything. So Larry Summers is taking these 3 things to basically say, hey, Jerome Powell's wrong. Like, everything that they thought, they've been wrong about. So now it's time to kick him out and have a strong Fed take action against inflation. That's what Larry Summers believes, who's a Democrat. And so this Wall Street Journal editorial piece really paints the possibility that we could have 2 things happen here. Well, actually, we could have 3 things happen here. And then separate consequences for all of these 3 things here. So we'll write down these 3 things here. Number 1, you could keep Powell. If we keep Powell, then it makes it a little harder to get the Build Back Better plan done in the Senate, but Biden can really distance himself from a Trump appointment. So Biden can just point to the fact that Powell is a Trump appointee and, it's not his fault. So Biden can stay distanced from the Fed, but it hurts him with the Build Back Better plan. If he ends up picking somebody like Brainard, and she ends up acting like Powell, well then, unfortunately for Biden, Biden takes responsibility. Biden takes the R. And it probably doesn't help him with the Build Back Better either. So here we could call it a plus for Biden that Trump takes the R, the responsibility, but it hurts his Build Back Better plan, keeping Powell. Going to Brainard means Biden takes responsibility. He probably doesn't get much help with Build Back Better. And we have the risk factor that we could get somebody who ends up flip-flopping, which would create a lot of uncertainty in the market. Or you could have something like what Larry Summers, what the editorial board here is saying, the Wall Street Journal editorial board. You could have a total blindside, end up getting somebody who's a hawk like Larry Summers, who's kind of like a Paul Volcker Democrat. Get in there, cut inflation, raise rates, cut the taper, fight. You've even got Richard Clarida, who just came out and said, quote, "It may be appropriate to discuss the taper pace in December." In other words, maybe taper faster, right? That's more hawkish. Larry Summers is somebody who'd probably be very, very hawkish. This would probably be a positive for Joe Biden getting the Build Back Better plan done, because it would show that he cares about inflation, and he's going to do everything in his power to try to reduce inflation as soon as possible. And he could potentially use that as leverage to convince Sinema and Manchin to pass the Build Back Better plan, which would be good for Joe Biden politically. But it could have long-term consequences of if we potentially tighten too soon, we could end up tightening ourselves into a deflationary recession, which is bad. And that's the same thing that happened in 1949. The Federal Reserve tightened too soon, and we tightened our way into a deflationary recession and deflationary spiral, which is where people stop spending money because they expect prices to be lower in the future, which is really bad. People don't spend money, the economy suffers. Remember, velocity of money. You don't spend $1, you rob our economy of $5. That's the way it works. So that could be good for Build Back Better. It could also be good for Biden politically in the short term. Long term, it could have consequences, but we might not see long term for another 4 or 5 years, and Biden might not be president, in 4 or 5 years. So, in terms of the market, though, what's probably best for the market is Powell. So Powell would be a triple plus for the market. I think Brainard would be a single plus for the market because we're going to get the flip-flop uncertainty of our history. Larry Summers would probably be a minus for the market, at least in the short term, because he's expected to be a hawk. Now, right now, there isn't public discussion that Larry Summers is even an option. In fact, we're not even aware that Larry Summers has been interviewed by Joe Biden. Maybe he has. We don't know everything, but we don't believe he has. So right now, the highest likelihood, the largest, like if I were a betting person, I would probably bet somewhere around 70% chance that we end up keeping Powell. Maybe a 20% chance that we end up with Brainard. Actually, I'd probably call that 25%. And then maybe like a 5% chance that we get some crazy shock out of left field and we get something like a Summers. That could potentially lead to some negativity in the market. But otherwise, I'd say the Fed issues here are more bullish than they are not bullish, odds-wise. Like the expected value here is very bullish for the economy and for markets. And it's difficult not to be investing in the market right now because the market's just zooming. Now, I've gone to cash to some degree. I'm about 8.4% cash. And it's mostly because I'm looking for those opportunities. And as soon as I find one that I feel confident in, I'm going to jump on it. And of course, once I find that, I'll be sending alerts in Stocks and Psychology Money Group. So use that Black Friday coupon code. Check out the programs link down below. And folks, we'll see you in the next one. Thanks so much. Goodbye.